Welcome back. I'm Peter St. Onge. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. Are we headed for a 1970s oil crisis? Will the motorists of America be fighting over gasoline like it's Cabbage Patch Kids in 1984? A week and a half into the Iran war, the main impact so far has been oil prices. But oil shortages are next, with roughly 1/5 of global exports exposed to Iranian missiles. Fortune calls this a, quote, energy shock coming like a tsunami for Asia, for China, Japan, Korea, and above all, India. America happily is insulated since we drill most of our oil here at home. We drilled. Just 2% of our oil is imported from the Middle East. Europe is almost as good. They get oil from Norway, black market oil from Russia, and of course U.S. exports as well. It's a different story in Asia. Half of China or India's oil comes from the Middle East. Korea is 2/3. Japan is almost 95% Middle East oil. That means a long war impacts the U.S. or Europe mainly by oil prices, but the shortages hit Asia. The question is how fast. So the first to go is India, along with Pakistan and Bangladesh. They have at most 30 days oil, since they have almost no stockpiles because their governments are dysfunctional and cannot repair a pothole, much less a strategic oil reserve. Southeast Asia is almost as bad. Indonesia or Philippines have maybe 60 days and a history of riots when there's no gas. Japan and Korea plan ahead and have enormous stockpiles, so they probably got 7 or 8 months. And finally, China, who has just 3 months of stockpile between government and private stocks. In days, that's almost identical to U.S. stocks, 85 days, but the difference is America produces 14 million barrels a day, about 2/3 of consumption, with Canada, Mexico, and now Venezuela making up the gap. But China produces just 1/4 of consumption, about 4 million barrels, with the Middle East making up nearly 2/3 of the gap. So China's got 3 months, Southeast Asia's got 2, India's got just 1. And what happens then? 2 things: restrictions on consumption and strangling the factories that sustain Asian economies and jobs. China has already banned export of diesel and gasoline. Others will follow. They'll try price controls, but those make shortages worse. People go to the black market, which carries a risk premium as well as a scale premium. So next is rationing to households. Things like if your license plate ends in a 9, you can only drive Monday and Wednesday. And then factory shutdowns, starting partial, maybe you have to close on the weekends, then expanding until the only ones who can get oil are government. Governments always eat first, hospitals, and maybe farmers. Now, this is all painful. It implies tens of millions of layoffs in Chinese factories, and fuel shortages have historically caused mass riots in India or Indonesia. So what they'll try instead is buy up the rest of the world's oil, jetting off to Texas or Norway with great fistfuls of dollars. That could, in theory, cause shortages in the U.S. and Europe. But remember, if oil stays at $100 or $150, there's a lot of marginal U.S. production that comes online. So we'll have enough, even with Asians throwing money at West Texas crude. And worst case, Trump just bans oil exports. Texas crude drops $20 and everybody else stays expensive. So what's next? The war drags on. It will cause worldwide convulsions that hit Asia hardest and then cascade through oil prices to a slowdown in the U.S. and possible recession in Europe. Will not be the 1970s, but in a long war, it could get close. Jobs crashed last month in the biggest monthly job loss since COVID. That's before the war, which sent oil prices up 40%, raising fears of stagflation. Are we headed back to the Biden miracle? Last Friday, the notorious Bureau of Labor Statistics announced job numbers for February. Now, markets were expecting 55,000 job gain, but BLS says we lost 92,000 jobs. Plus, they revised away another 69,000 imaginary jobs from the previous 2 months. That took unemployment to 4.4%, which is tame in the grand scheme, but is almost a half point higher than when Trump took office. It was 4.0 at inauguration. The previous month was a big beat on jobs, so what changed? A big chunk was one-offs, a statewide healthcare strike in California and cold weather nationwide, which hit construction, were good for about 50,000 job losses. Hollywood lost 10,000 to AI. I did a video last week on this featuring the world's smallest violin. Another big chunk was migration, which has been the main reason for paper weakness in jobs all year. To illustrate, Biden was taking in at least 200,000 migrants a month, and Trump cut that to nearly zero. According to Trump's chief economist Kevin Hassett, that knocks off about 70,000 paper jobs every month. That was the Biden miracle. And that's because fewer humans in the country is fewer jobs. They're not eating at Wendy's, getting haircuts, or getting dialysis on your dime. Put it together, and the 92,000 goes to 42 on the one-offs, and then it goes positive on the illegals. Now, that's been a pattern all year. The BLS household survey says jobs were down 200,000 across the economy for 2025, but jobs were up 400,000 for native-born Americans. The entire loss was deportations. Toss in 300,000 federal layoffs, of which 90% are native-born, and it takes non-government native-born jobs to plus 700,000 on the year. That's about 0.5% growth, which is almost precisely equal to native-born population growth. Still, there's a problem because jobs should be growing, considering GDP jumped close to 3% last year. So unemployment should be coming down. The most likely culprit there is artificial intelligence, finally starting to replace white-collar jobs. Now, it's not hitting layoffs yet. Companies try to retrain since good people are hard to find. It's more like no hire, no fire. So you keep what you got, you don't hire anymore. Thing is, this sucker punches young workers. They become ground zero for AI. According to the BLS, in the past 2 years, unemployment for 22 to 27-year-olds is up 40%, close to 6% now. One study found just a third of college grads land full-time jobs in their fields last year. That's down 10 points in a single year. Another study found entry-level tech hires are down a quarter in the past year, while 2/3 of companies are reducing entry-level hiring across the board because of AI. This will get worse as AI improves hallucinations and starts rolling out in companies, meaning there is a tsunami coming for the young, unless they're going into the skilled trades, the service trades, or nursing. So it's next. Jobs have been noisy all year. In fact, they've been noisy since COVID. But strip out the noise, the migrants, and the federal layoffs, and it's still a lot weaker than it should be. Help was coming in Trump's tariff-driven factory boom and Fed cuts, which are together worth millions of jobs. But the Supreme striking down tariffs and now the war could put all those beautiful factories on hold, while oil prices could spook the Fed to pause or even reverse cuts, meaning for young workers, it could get a lot worse before it gets better. A word from our sponsor. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington. The inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold paid in more ounces of gold. You retain ownership of real, allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. Now back to our show. China just set its lowest GDP growth target since 1991. That's going back 35 years. And that's before the war, which just doubled oil prices so far. Meanwhile, China is projecting a budget deficit of 4% of GDP, which is nearly twice Japan's deficit. In fact, it's almost as bad as Republicans in Congress. Is the China miracle over, replaced by a Japan-style, centrally planned zombie economy? Last week, Chinese Premier Li Qiang announced a 2026 growth target of just 4.5% to 5%. Keep in mind that's the target. Chinese statistics are notorious for overstating growth. There's a huge cut to the 10% growth China used to see. Even China cheerleader Bloomberg could not sugarcoat it, writing it signals, quote, Beijing's tolerance of slower growth while it searches for new sources of growth. Keep in mind that's all before oil prices went to $120 a barrel, which according to the IMF could knock that down to 3% growth, which is lower than Bangladesh. Now, every time I say China's in trouble, the China chorus gets upset with me, so let me take a moment to praise what China is doing well. They're obviously cleaning our clock on educating the bottom half of society. On crime, bad guys actually go to jail in China. They're aggressively unwoke. You can't show gay people on TV, never mind gender changing. China's regulation is much more business-friendly. Yes, communists regulate less than Congress. And infrastructure, where Chinese costs are 5 times lower than the U.S., even after adjusting for incomes. To illustrate, China built a nationwide high-speed train system of 30,000 miles in 15 years for $30 million a mile. California spent 17 years failing to build a train at $220 million per mile. So in many ways, China works. The problem is the Communist Party still centrally plans the economy. Now, that worked when China was simply copying other countries. It was building trains just like Japan. The problem is once you catch up, bureaucrats are notoriously bad at economic planning. Now, the logical thing to do is step back, let business make the decisions, declare victory, and go home. But central planning is a heck of a drug, especially when a big chunk of the economy is owned by officials in the army, in the Communist Party, or state-owned enterprises that make up 1/4 of the Chinese economy. The risk is what happened in Japan when the easy wins went away. The political system shifted to protecting existing big business at the expense of startups. Japan built a zombie economy. To illustrate, of the 100 biggest companies in the U.S., 15 did not exist 25 years ago, including Facebook, Tesla, Netflix, Uber, Nvidia. Of Japan's 100 biggest companies, 0 are new. Existing businesses hogged up and wasted the capital and the workers. Now, China is already well down that road, having plowed $7 trillion bureaucrat dollars into manufacturing to the point it is comically overbuilt. To illustrate, at peak electric vehicle, the U.S. had 25 companies making EVs. China had 500 in a smaller economy, of which 400 have already gone bust, 100 to go. So as next, China's having a bad 2026. They had a property crash, then the trade war. Trump took out 2 of their biggest suppliers of cheap sanctioned oil, Venezuela and now Iran. And if Iran keeps going, they're facing an effective blockade of Middle East oil that could cripple manufacturing in just 3 months, which could cost over 100 million jobs. If fast growth is over, the historically rambunctious Chinese public will lose patience with their tormentors. Even China could start getting spicy. Democrats are hopping mad. We are at war in the Middle East, yet the Strategic Petroleum Reserve is a third empty, which, to be fair, is a lot better than Los Angeles fire hydrants. Now, this is fun since it was Democrats who drained the reserve, most famously Joe Biden, who pawned half the reserve in order to buy the 2022 midterm elections. In fact, he drained it so fast, he permanently damaged the pipes, so it would now take 7 years to refill. Meanwhile, Democrat Congress spent years starving the reserve, even in early COVID when oil prices were literally negative. All whilst Donald Trump has been refilling the reserve about as fast as physically possible since the day he retook the White House. Now, this may not surprise you, but it's long-standing tradition that Democrats never want to fill the Strategic Petroleum Reserve because there's always a needy leering senator somewhere in Minneapolis who needs the money. The U.S. Oil and Gas Association shared a heartwarming anecdote during early COVID when oil prices literally went negative $37 because oil storage and tankers were stuffed full. At the time, they urged Democrat Congress to buy since you were literally getting paid to buy. USOGA said Democrats, quote, told us to F off, literally. So the background is America's Strategic Petroleum Reserve was built in 1977 to insulate oil prices from a Middle East war. It was originally built for a little over 700 million barrels, which at the time was 100 days of imports. And it was built with asymmetric pipes, so it dumps fast but fills 7 times slower. The logic being you fill it gradually, but in a crisis you need it fast. In fact, it took close to 30 years to fill, 2005. And then it stayed full, around 600 to 700 million barrels, all the way to Joe Biden, who found the perfect emergency for the reserve, the 2022 midterm elections, when federal spending launched double-digit inflation that risked an election wipeout for Democrats. In just 6 months, Biden dumped 200 million barrels to manipulate gas prices. Fun fact, the dump literally ended on Election Day, which is cynical even for Washington. The dump was so fast, it permanently damaged the pipe, so filling it is not 7 times slower now, it is 40 times slower. So that was the tiny straw they handed Trump to refill the reserve. Despite all that, we're actually in surprisingly good shape because we're drilling a lot more oil than in 1977. So even after Biden had his way with the reserve, we've got close to 200 days of net imports and close to 4 years of Middle East oil. So a 4 years is plenty of buffer for shortages. We won't see gas lines. But the reserve is not just about shortages. It's about being able to smooth out oil prices when they go crazy. Like, say, last weekend when oil moved 25% in a matter of hours. It's there that a couple hundred extra barrels would be nice to have, no thanks to Democrats who are now crying the loudest. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada. They're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. Vladimir Putin is threatening to embargo natural gas shipments to the European Union. This could double gas prices in Europe, sparking a recession chasing the rest of Europe's heavy industry to America and leaving European households facing thousands in electric bills. Perhaps Europe should not have closed their coal plants to entertain climate activists. Earlier this week, Vladimir Putin took advantage of the Iran war to tighten the screws on Europe, using that, quote, perhaps it would be more profitable for us to stop supplying the European market in favor of other, quote, interesting markets, presumably China and Asia. The context here is natural gas is a much smaller market than oil, about $150 billion a year exported compared to $1.3 trillion for oil. But it's also an essential market with about half of natural gas going to electricity generation, so gas is much cheaper than oil. The balance going to heavy industry, so steel, chemicals, fertilizers, and household heating. The problem is natural gas is much more rigid than oil, which you can put on a boat and aim anywhere. In the case of gas, it's limited by infrastructure because natural gas requires cooling to negative 260 degrees Fahrenheit to make it liquid, unlike oil that's liquid at room temperature. This means there is not a global price for natural gas. It's different prices everywhere. So you've got Henry Hub in the U.S., the Japan-Korea marker, JKM in Asia, and TTF in Europe. Now, Henry Hub U.S. prices have barely moved on the Iran war since the U.S. is a net exporter of LNG. So oil moved 50% depending on the hour, but Henry Hub only moved up 10%. It's a very different story in Asia and Europe. TTF was $32 on the eve of the war, spiked to $54, and now are around $49. So that's up around 50%. The problem is the Middle East supply that spiked Europe's gas prices only represented about 8% of Europe's supply. But Russia is currently supplying almost twice that. In other words, 8% of supply spiked prices by half, and now Putin is threatening to triple that hit. This would gut what's left of European manufacturing, especially energy-intensive industries like steel, cars, and building materials, as well as chemical-intensive industries, including fertilizer for farmers. It did not have to be like this. You may recall back in 2018, Donald Trump warned Germany it would become, quote, totally dependent on Russian energy if it did not start building infrastructure for U.S. gas imports. Germany's diplomats smirked at the dumb American. They kept smirking when Trump warned Germany to stop demolishing their coal and nuclear plants for the global warming pixie farts. Of course, it played out exactly as Trump warned. Germany demolished 15 coal plants and all of their nuclear generators, knocking out nearly 1/4 of their energy and spiking household electric rates to 3 to 4 times U.S. rates. And 8 years later, Putin is still blackmailing Europe with gas. So as next, it took the Ukraine war for the EU to finally build terminals to buy American gas, but they were still using cheap Russian gas, even though in theory they were at war. They'll now scramble to buy American to avoid an industrial wipeout and voters waving electric bills with their pitchforks, but that will take months since LNG supply is generally locked up in long-term contracts. So Europe is left praying for a short war with no backup plan and remains at the mercy of Vladimir Putin. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.